What's going on, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. So run the clip. So today we're going to be talking about paying off multiple credit cards using a line of credit. But before we get started, make sure to take a little time, smash that like button for me. Also, take a little bit more time, hit the subscribe button for me. My goal is to have this channel reach 10,000 subscribers by the end of the year. So I appreciate you guys taking that little bit of time to do so. Much love. So I know you guys are asking, why would I use a line of credit to pay off all my credit cards when both of them are calculated by simple interest? Why wouldn't I just use my income, my paychecks, stuff it into my credit card, and then use my credit card to pay my expenses? And then the leftover cash flow will slowly pay off my credit card. So don't get me wrong, it's a very good method to use, but a lot of individuals cannot pay all their expenses like rent or mortgage or things of that nature on a credit card. So how else can we use the velocity banking and pay all of our expenses? This is where the line of credit comes into place. So we're going to be using our line of credit like a checking account. So whenever you get your income, your paycheck or whatever it is, you're going to put that money directly on the line of credit to pay that line of credit off. And whenever you have an expense or bills are due, you're going to transfer the money from your line of credit to your checking account and then pay that expense in cash. Now the cash flow that's left over on your line of credit will slowly pay that line of credit down every single month. Now with this method, you're not going to worry about if your line of credit can pay all your expenses, because essentially the line of credit is like pulling out cash. So I know this might sound confusing and a little complicated, but trust me, it's not. I have a whiteboard example for you guys. So let's get to it and break it down. Let's go. All right, so we're on the whiteboard. Let's get into it. Let's dive into the scenario here. So we have an individual here. Their income is $4,000 a month. Their expenses are $3,700 and their cash flow is $300. So if you don't know what a cash flow is, it's going to be the income minus your expenses. So 4,000 minus 3,700 equals $300 left. So that would be your cash flow. Now this individual has 3 credit cards here. Credit card 1, $1,000. The interest rate is 25%, minimum payment 75. Credit card 2, $1,000, interest is 30%. Still that same minimum payment of $75. Credit card number 3, $1,000, interest rate 35%, minimum $75. So this individual wants to pay off the credit cards and the interest is astronomical, right? So what this individual did, they went to the bank, they got them a line of credit, and the line of credit that they got is $6,000. And the interest rate on that line of credit is 10%. So let's go to the other side of the board. Let's look at the formula and see how we're going to pay all these credit cards off. All right, so we're on the other side of the board. So let's get to see how we're going to pay our credit cards off. So first thing, it is January, the month of January here. So the first thing this individual is going to do, they have a $6,000 line of credit. So what they're going to do is use their line of credit to pay off all their credit cards. So they're going to get $3,000 of the line of credit, pay off the credit cards. What that in turn is going to do is free up our cash flow. So we increase our cash flow by $225 and we decrease our expenses by $225. And the reason why that happens is because our credit cards is actually part of our expenses. So once we eliminate that as an expense, we're freeing up the cash flow because our expenses go down here. So that's how that happens. So the next step, we're going to take our personal income, our $4,000. We're going to take $3,000 of that income, and then we're going to put it onto the line of credit to pay the line of credit off in full. Now, when your income comes in, you want to put it on the line of credit as fast as you can, because what happens is when you have a balance on your line of credit, then it accrues interest. It accrues simple interest. And I have a video about how simple interest works here. So make sure to check out that video if you have not. But so the first thing, again, what we're going to do come January 1st, when you get your line of credit, pay off the credit cards so you can increase your cash flow. Once your income comes in, let's say your income comes in, I don't know, the 15th of January, then you pay off your line of credit. You're going to use that $3,000 to pay the line of credit back in full, so the interest will not accrue. So the next step is we're going to use the remainder of our income. So we use $3,000 to put our line of credit to full. So that means that we have $1,000 left out of the $4,000. We're going to use that on our expenses. So our expenses at first was $3,700, but when you minus the $225 to it, then our expenses are only $3,475. So we're going to put $1,000 on that, and then that makes our expenses $2,475. So the next step, how are we going to pay our expenses? And remember, the expenses has the rent rolled into it as well too. So the line of credit, if for those that have not used a line of credit, you can pull the money out and it's just like cash here. So out of the $6,000 that you have on your line of credit, you would pull out $2,475 to pay your expenses. What's left on your line of credit is $3,525 for the month of January. So let's look here. The month of January, $3,525. Your credit card debt is zero. All right, so we're in the month of February. So the first thing you're going to notice, I put a little purple magnet. Basically, this equation is done because we have paid off all our credit cards. Now, again, the advantage of this is that we increased our cash flow by $225. So that's going to allow us to pay that line of credit down a lot quicker. And the line of credit interest is only 10% as opposed to 25, 30, and 35% here. So the first thing that we're going to look at, so for the month of January, we had $3,525 on our line of credit. To pay that off, we're going to have to use our income, $2,475 of it, to pay the line of credit off in full. So if we put that on there, our line of credit's back up to that $6,000. And when it's paid off, no interest is accruing. So again, once you get that income, you want to put it into that line of credit as soon as possible here. So second, we're going to use the remainder of our income, $1,525, and then we're going to use that on our expenses here of the $3,475. When we do the math, our remainder expenses is $1,950. So how are we going to pay the remainder of our expenses? We're going to use our $6,000 line of credit. We're going to use $1,950 of that, and it's going to leave a remainder amount of $4,050. So if we look at the month of February, our line of credit has $4,050 on it. Our debt for our credit cards is zero. All right, so we're in the month of March. So the first thing that we want to do is pay off our line of credit. So if we look in February, we have $4,050 on the line of credit. So the remaining balance is $1,950. So we're going to use our income to pay off that line of credit to equal that back up to $6,000 to pay it off in full. Now, the next step is we're going to use our remainder income of that $4,000, which is $2,050, and use that on our expenses. Now, when we do the math here, the remainder expenses is $1,425. Now, the next step is, since we paid our line of credit off in full, we can use that line of credit to pay the remainder of our expenses. Now, when we do that, we have $4,575 on our line of credit. So if we look at the month of March, $4,575 on the line of credit. The debt for our credit cards is zero. All right, so we're in the month of April. So the first thing that we want to do is pay off our line of credit once our income hits our bank account, right? So the line of credit, we have $4,575. We want to pay that back up to $6,000. So we're going to take $1,425 of our $4,000 income, pay off the line of credit in full. Now the next step is we're going to take the remainder of our income, $2,575, and put that on our expenses, $3,475. This leaves a remainder of $900 left for our expenses for the month. Now we want to take our line of credit, the $6,000, and use $900 of that line of credit, and then it leaves our line of credit at $5,100. Now, if we take a look here, for the month of April, we got $5,100 for our line of credit, and the debt for our credit card is 0. All right, so we're in the month of May. So the first thing we want to do, look at April. Our line of credit has $5,100 on it. So we want to pay that line of credit once our income hits our bank account here. So we're going to take $900 of the $4,000 of income that we're getting, and then we're going to put that on the line of credit to pay it off in full. Now the next step is we're going to take our remainder income, which is $3,100, use that towards our expenses, and that's going to leave us left with $375 of expenses. And how are we going to pay our expenses? We already know we're going to use our line of credit of $6,000 on there to pay off the $375. This leaves our line of credit with $5,625 on it. So we look at the month of May, line of credit $5,625, and our credit card debt, again, is going to be 0. All right, so we're in the month of June here, the last month. Let's break this down and pop open the champagne because we're going to pay everything off here, right? So the month of June, we want to look at the end of May. We see that our line of credit was $5,625. We want to pay that line of credit off. So we're going to use $375 of our income and pay the line of credit off in full to bring it back up to that $6,000. Now, we'll use the remainder amount of our income, that $3,625, to pay our expenses. So our expenses will be 0, and then we'll have an actual cash flow of $150 left over of our income. So last step, we see our line of credit $6,000, our expenses are 0, which leaves our line of credit back at that $6,000. Now again, with the $150 left on cash flow, if we did the simple interest with this scenario, it would probably eat up around that $150. So that's pretty much how much you would be paying in interest if you got that line of credit with the 10%, and right when you're getting your income, you're putting that money into your line of credit and putting the line of credit in full, so the daily interest won't occur. Again, if you have not seen the video of simple interest and the accrual of it, it is not a lot when you're putting that money constantly in and slowly taking that money out to pay your expenses. So that's one thing I do want to highlight here. Again, if this video was helpful, hit that like button for me. If you haven't done so yet, remember to subscribe to the channel as well. This is another basic velocity banking scenario on how to pay down that debt, how to pay off the credit card. So if you think about it here, the average person with their cash flow, $300, they would slowly pay off those credit cards, right? So let's say credit card number 1 has $1,000 on it, right? 3 times 3, that's $900. You would have to do an extra month to pay off that credit card, right? So even if we just said on average 3 months, right? That's 369. That's 9 months. And we know that we're going to have to add some extra months because 300 isn't paying off 1,000 in 3 months. So again, we've paid this off in 6 months. So you see the benefit of having that line of credit to pay off those credit cards to increase your cash flow, because our cash flow was $300, but once we paid those credit cards off, it increased by $225. And this is a way that we are pretty much paying down that debt faster. So hopefully that does make sense. Hey, if you want me to do another similar scenario like this, let me know down in the comments. Like always, you guys have a good day. Have a blessed day. Peace out.